too easy as a young founder to chase the dollars. It's really exciting to have a big company write you checks, and they will start to lead you a direction that is different than your original vision. And then a year or two from now, you're like, oh, the company's not working because we ended up doing what we didn't want to do. And it's because you follow the dollars versus blazing a new trail.
Welcome, everyone, to today's episode of The Making of a Nobody. I'm your host, Sejal Thacker, and joining me today are two incredible guests. I have Mark McNally, the founder and chief nobody at Nobody Studios. Mark is a serial entrepreneur. He has built, scaled, and funded countless ventures. So welcome back, Mark.
Thanks, Sejal.
Great to see you. And also joining us is a fellow leader at Nobody Studios, Andy Walsh. Andy has deep experience in helping startups at all stages of their journeys, including funding. So thank you for being here, Andy.
Oh, it's great. I love these conversations, and it's actually a nice chance to sit down and talk to you too, Sejal.
Thank you. Thanks. Well, today's conversation couldn't have come at a better time. I think with our current economy that's constantly throwing curveballs at the startups left and right. And so I think what we're going to talk about, non-dilutive funding, is an attractive option for some companies, right, to consider. So we're going to talk about the benefits, the challenges, and maybe share some ways that, founders can position themselves in order to be able to secure this kind of funding. So for us that don't know too much about this topic, right, me included, to kick things off, let's start with the basics, right? Can one of you explain what non-dilutive funding is and how it works in practice?
Yeah, sure. I'll take a first stab. Look, when you need capital to grow your business, a lot of people think of selling a portion of the company, right? So that's dilutive. You may have started it in your garage, on 100%, or you started with 3 partners and you guys all own, 100%. When you raise capital, you're giving up a portion of that company, right? And depending on what kind of valuation you can achieve and how much you need to raise, you might be giving up 20, 30% of the company on the first round. And if you need subsequent capital, you could continue to be diluted, which is not a horrible thing. And I don't know the stats. I think Zuckerberg owns like 20% of Facebook or something. So it's not like the most successful from a wealth perspective or people who own 100% of the company. What matters is you bring in the capital you need to grow, right? But again, it all depends on the type of scale you're trying to accomplish. If you need to bring in capital, do long-term investment into an idea or a product, you probably need people who are thinking like partners or buying into that vision. And that tends to lend itself towards equity, right? Now, non-dilutive means you still need the capital, but you may not have to sell a part of your company, right? So how does that work? I would just give you maybe a history lesson, right? Non-dilutive fundraising in the tech space really came from non-dilutive funding in the manufacturing space. So let's say you invented a new shoe and you think it's a really cool design and you're doing really successful at it. You're selling it, one by one on the street corners, you go on the websites, whatever, you're growing sales. And your sales are helping to fund your growth, probably in this like mom and pop space. Now, let's say you land an order from Walmart for $1 million of your shoes. Okay. Maybe your costs to make those shoes are $600,000. Okay. If you sell a piece of your company to make that, because you're not going to get paid until you make it and you deliver it, right? Then you're essentially being penalized by your own success. Like you made a huge sale and you're losing a part of your company. Right? And there's an entire industry created in the last 50, 60 years called factoring and purchase order financing, where they will look at that space and say, well, you've got $1 million purchase order from Walmart. I will give you a loan on the $600,000, but you're going to pay me back $660,000 when they pay you. And they put themselves into the payment transaction to make sure they don't get cut out, right? But for you as a founder, you get a chance to say, well, I get to grow. I get to go to 5 million and 10 million. I'm never going to have to lose a part of my company. I'm just giving up a piece of the profits to grow, which is easier than giving up part of your company, right? So you shouldn't have your success in sales or revenue growth ever penalize you in terms of ownership, right? Unless you need a long-term strategic partner. So that's really where non-dilutive capital came from. It's been trickling its way into the industry the last 10 years. That's probably first time I saw it was probably 10-ish years ago. But now it's becoming more and more mainstream, and there's some very large companies that provide non-dilutive capital. And their angle is very similar to what I just described in the Walmart example. Let's say you built a software as a service business, a SaaS business, or an e-commerce business, and you have a historical track record of sales, right? Or in a SaaS business, you have people who are going to pay you every single month, and they're on 12-month contracts, right? They can look at it the same way they would in that Walmart transaction and say, well, you've got $4 million in guaranteed revenue this year. I will go ahead and loan you $2 million against that revenue, but I get paid before you do, right? And they might say, I'm going to give you 2 million, but you got to pay me back 2.4. But again, now you're bringing in the money you need to grow your business, but you're not giving up a portion of your company. You're just giving a portion of your profits. And in the long scheme, giving up a portion of your profits is scalable. If you give up 5% of your profits forever and you grow to $1 billion, who cares, right? But if every time you get a new order, you have to give up 5% of your company, you're not going to own your company very soon, right? So that's what non-dilutive capital is. Now, for founders listening in, it's two things. If your business needs long-term R&D, research and development, and product development, non-dilutive capital will never help you, right? It's the kind of thing for people who have traction. Now, that can be a great thing as a focus filter for founders. If they can say, you know what, I want to get to X amount of revenue with the least amount of capital raised, because then I'm unlocking capital that won't dilute me. That's a great focus filter. You should be metrics focused as much as possible. But that's what non-dilutive capital means in the tech space at a high level.
You said so much there. And Andy, I just want you to talk about this because, this topic is becoming more popular recently. And so what do you think some of the reasons for that are, and what are some of the trends that we're seeing out there?
Yeah, it's an interesting inflection point right now. We've seen the really sort of heavy investment levels that came through 21, as in 2021. And it's a different game now. And I think what happened is that when there's more capital, more businesses get funded, which gives more people a chance. But then the accountability that comes from both the founder, but also the VC. So that relationship's really important. So I think one of the things that founders are looking at now, it's not just capital, it's actually the relationship and the support and the partnership that they have with that traditional sort of VC partner. And then that dynamic can change the game. So I think sort of it can be a positive or it can be a negative experience. So the dilution happens with that investment, but they also traditionally would get a seat at the table, and that can be at a board level. It can be in other roles as well. But that cultural change is something that factors in. And I think what we've seen now is where there's been some stories where VCs have had the ability to influence the business to a point where it may not actually retain the same sort of intention as far as its growth, whether that's more organic versus revenue focus, and that pressure to drive that quick turnaround to growth is very complex situation to manage. And they can be an ally, as I said, but they can also be complicated. So that's just one thing that's happening at the moment. I've been reading a lot around the bootstrapping piece, and that's not for everyone in the sense of a cash flow problem becomes a going out of business problem, where it's if you don't have capital behind you, then you can sort of hit the wall pretty quick. I've bootstrapped my own business, and it was a service business that sort of scaled into an IP business. So we had long-term revenue streams, but at the start we had I'd say luxury is probably not the right word, the flexibility to be able to bill our services out while we're growing our business. So even that, the way that you can get money in the door that allows you to build something out concurrently, are trends that we're seeing a lot too. So non-dilutive for a lot of people there's pros and cons. And I think this is what we want to unpack today. What are some of the options? And even within the nobody side of things, the way that we invest in creating our companies, and our goal is big. It's to build 100 companies, and each of those will have different ways of generating revenue. And something that I'm curious to hear from Mark further as well is how do you start to think about what the right financial strategy is for organic revenue and making enough money to grow, but then also how do you potentially bring in investment partners, either dilutive or non-dilutive, to help set the right trajectory for where your business needs to get to and how you become successful in your own category.
Yeah, so I think both of you have already started to talk about this, but let's go a little bit deeper, right? So what are some of the key benefits of non-dilutive benefits for startups, especially when you have, again, economic uncertainty going on, right? So what are some of those benefits?
Well, so I talked about one type of non-dilutive capital, which is essentially borrowing against success, right? So you already have, revenue, you already have traction. There's a universe of people now who will lend against that didn't even exist 10 years ago, right? There's another source of non-dilutive capital, which is you can partner with your potential customers. So I did say if you're trying to build something that doesn't exist and you have to need some time to build it, that's probably not a good source. The only way it is a source is if you get a partnership. So let's say you approach a big corporation. Big corporations are notoriously not good at innovating new things, right? But it's not because they don't have the talent or the vision. It's just because those smaller things that aren't proven don't make the cut in big corporations in terms of priorities, right? But they can see, hey, if we could figure that out, that would be really cool. If we could figure that out, that would be really valuable. And big corporations have buckets of money in different sources for development, for R&D, for partnerships. And so what might seem like a lot for you as a startup, $250,000, $500,000, I've seen $2-3 million deals in these categories of like development funds where a corporation can say, I like your team, I like what you're trying to do. If you can do X, Y, and Z, we'll pay you X. So it almost looks like a consulting kind of deal, except you own the IP. They just get some kind of rights to it if it works out, right? So if you have one company pay for your product to be built and they get a sweetheart deal for life, that might be a great trade out for you as a founder if you think there's 1,000 more customers you can go monetize that to, right? So again, another source of getting the capital you need to build your company, but you wouldn't be selling a part of your company. You would just be giving them a piece of the product you ultimately build, which is different. Again, that would be a way you could solve a long-term problem. What I like about that one, although it's harder, is it forces you to be very customer centric, right? If you're focusing on that, you're deep in your relationships, you're deep in conversations about what you're trying to accomplish, your value proposition, the strategic value, and you're operating at the highest levels of a potential customer, which is ultimately also a potential acquirer. And that's fantastic validation for you to go out there and find the next 1,000 customers, which could make your company a rocket ship, right? Again, not for every startup, but that would be a different type of angle of non-dilutive.
It depends on category too. Like I was talking to a founder the other night at an event I went to, and they're in biotech, and a lot of what they're doing is like large scale manufacturing. And for them to get penetration in various markets around the world quite often means having a plant that's based in that country. So if you're a company that is producing something that is a physical product, the option of debt financing becomes really interesting as well, where you've got an established trajectory, and being able to scale and grow into new markets means that you can ultimately get a loan of sorts with interest, but it's non-dilutive, but you get large scale capital to be able to grow what you're doing. And then complementing that, what they're also looking at as far as local grants. So in the US, there's a lot of states and cities and towns that will have their own programs to fund businesses that are creating infrastructure and creating jobs. So like for them, they had a two-prong approach of one, being able to get debt financing that was non-dilutive, but also get local grants that meant they had access to more capital to be able to grow that. And it helped them feed local industry and actually get access to programs to give them staff that would be able to work for them that were qualified and incentivized with tax benefits as well. So it's the category piece for them, and manufacturing was really clear path forward. And I just love, and I knew a little bit about debt financing, but the time that I spent with this founder was really like interesting for me to learn that. And I think that's what we're talking about today, is that the press release around getting a fundraising round is not necessarily what you should be seeking. And I see it all the time. If like someone says, I've raised 20 million on a Series B, and then 3 years later they're out of business, like that's not a milestone. It should be something that actually is very considered about thinking about what do you invest in, what does success look like with that capital, what does the new workflow and sort of legal structure look like, and then what's right for us with our category of business.
what are some of the challenges that founders face when they're specifically trying to get the non-dilutive funding?
Yeah, I mean, I think one of the examples I painted, if you are doing a strategic deal with a corporation that wants you to build a certain thing, right? The challenge with that is it's now you kind of have a contract and you're meant to deliver on that. And it can restrict some of what you need to be doing as a startup, which is pivoting or saying, oh, I don't like that feature anymore, or we decided that market's wrong. And the weaving you need to do as a startup to really find your fit can be restrained if you don't structure the contract right. Because now you're on the hook to deliver a certain thing, and if you don't get the contract right, you end up being more of a production house or a consulting firm. And my strong opinion is, if you go into those kind of deals, you have to be comfortable being very strong in your positioning and strong in your ego, for lack of a better word, to say we're doing this deal because it advances our goals and we know we can advance your goals, but these things we won't do, or these things are on the table. And it's too easy as a young founder to chase the dollars. It's really exciting to have a big company write you checks, and they will start to lead you a direction that is different than your original vision. And then a year or two from now, you're like, oh, the company's not working because we ended up doing what we didn't want to do. And it's because you follow the dollars versus blazing a new trail. And so you got to be careful for that. Again, I think that's where experience comes in. If you don't have the experience, get a great board or advisory board around you to like bring that to the table. I've learned it the hard way, so I have no problem being tough on those kind of conversations. I won't be pulled in the wrong direction because I know why I'm doing what I'm doing, and I'm not doing it to have a paycheck or have a company survive in under 12 months. I'm doing it to make a meaningful company on anything I do. So that would be the downside for sure. I think there's potential downside again on the financing side. Again, you could get in a spot, there's innovator's dilemma, where you have one successful piece of business gets in the way of you innovating the next successful piece of business. So if you're getting financing from something that's selling, even if you think that might not really be working out in 6 to 12 months, you almost can't stop that business because it's providing capital, right? You get locked in to keep doing the same thing versus, innovating in a new direction. So again, I don't think they're massive cons as long as you're aware of them, but there's certainly, if you don't go into it with the eyes all wide open, you could look back at it and go, why'd that guy Mark say you should do non-dilutive capital? This is the worst thing ever. So.
Right. No, and you said something really that just jumped out at me, Mark, is, the issue of not giving up ownership, how important that is, because if you have your own ownership, right, like you can preserve your vision and your long-term strategy, right? And I mean, we've had to deal with that issue, when we were dealing with our initial Series A partners, right? And I remember talking to you about having to make some tough decisions about walking away from, a lot of money, which obviously we needed at the time, but because we were, you had doubts about whether we would be able to retain the original vision. So I don't know if you want to talk a little bit about that situation.
Yeah, look, I think giving up part of your company, there's no problem with that whatsoever, right? You just need to be aware that you're bringing people into the party, right? As Andy said, they're usually getting a seat at the table. Depending on, how they are negotiating the terms when you're trying to get that, you can start to get a sense of their vision of what role they're going to play in the company, right? And, I do think that this is one of the areas where youth can be a challenge with investors. I do think the more seasoned folks have been through enough rodeos to know how they need to empower their teams, give them guidance, give them counsel, but not think that they have all the answers. At the end of the day, if you're making a passive investment into somebody, you should be counting on that team. If you go into it the wrong way as an investor, and I've seen this countless times, it's more common than not, the knee-jerk reactions, because they're only looking at the company, a couple hours a week or months, right? Whereas you as a founder, you're in it every single day. Again, if the economics are wrong and the board control, et cetera, is wrong, you can get in spots where you're like, yeah, we made a mistake here. We learned a hard lesson here, but now we know how to get it right in 6 months. And you just want to get busy working because you're a founder. And it can turn into this entire dramatic, show where potentially the board's trying to flex their muscles and say, I'm not sure we believe in your vision anymore, or we want to challenge that decision. And now you're spending, I've seen in situations where 20 to 30, 40% of my time has been focused literally on managing the board. right? And so I do believe bringing big scale capital, et cetera, is like a franchise model. You want to prove you got the business right, and you know you just need the capital to scale. Then the dynamics of that relationship are really easy. If you're still in a experimentation, trying to figure out what's going to work, and you personally use an organization are very open to lots of failure and lots of risk, most investors aren't comfortable with that, right? So you have to be very, very careful in picking who's going to be at the table with you. And that was one of the things that played out in the decision we made about a year ago when we walked away from a decent financing. Was it became clear in that conversation that every decision was going to be challenged, every kind of insight was going to be challenged, and it was being we and our team bring a 100 years of experience doing this stuff, and it wasn't the equivalent on the other side of the table. So you're going to find yourself in conversations you just really didn't want to be in. That's not to say you don't want challenges, you don't want to be accountable, you don't want governance. I'll never say that. I'm just saying you want most, when you're walking into something that's hard and you've got a lot of work ahead, you want most of your energy going into that, right? And I know all three, you two on the call know how I react to challenges. I might, be bummed for a day, but then I'm going to come back to the table and say, okay, right, let's fix it, right? What's the answer? How do we grow out of this? How do we solve it? Like, that's what we're here for. And none of these things ever surprise me, right? So again, the giving up your company or parts of your company to grow, not a problem whatsoever. It's just a matter of the dynamics you weave into an organization, especially at an early stage. If you haven't really nailed your product market fit, bringing in someone to the table you're not completely bought into, other than the capital, is a challenge.
Great stuff, Mark. And what I'm hearing and is that you got to balance. It's all about balance and figuring out. I think non-dilutive funding seems like a great option if you need that financial sort of runway to hit certain milestones when you don't have to sacrifice the equity, right? But at some point, you might need the equity funding to scale. And so, Andy, I would love to hear. One of the things we promised people today for tuning in was to give some founders some advice on what are things that they can do to make themselves more attractive to non-dilutive funding, if that's the right kind of funding source they're looking for. And maybe you could talk about some specific metrics or milestones that they can strive for.
I think for me, it's focusing on, first and foremost, getting some retention with customers and getting revenue momentum. And it's the ability to be able to get people in early, grow that, and having a level of conviction and confidence that that's something that you can continue to do. And from a traditional investment standpoint, revenue momentum at product solution fit stage is one of the key things that people are looking at. But I think from a growth perspective, if you're able to identify, okay, like we have a competitor set, we feel that if we're able to release X feature or do something that has a significant impact that you can track through historic metrics, and that capital allows you to sort of leapfrog your competition and gain bigger market share, then you're thinking about strategic advantage there too. So you become the brand of choice. And, a historic example there, if you look at where Lyft started, and Lyft was a bit of a pivot as a product, probably a better product, and then Uber came, and Uber got much higher fundraising, and Uber now has almost become the verb as far as getting a ride share in the sense of how you do it and anything else. So for them, that early market sort of penetration and advantage allowed them to become the player that they did. And there's obviously a lot more behind that, but a really simple example from that. So there's tactical reasons why you would spend, but I think the question when you're looking at investment is, like, it's, as I said before, it's not a press release. It's something that's a strategic move to help give you an advantage against competitors, to hit a milestone, to take pressure off, grow your team. But so you need to understand why you're raising capital and have a clear plan for what that amount is and how you spend it. Look at the options like we talked about. Dilutive funding, as Mark said, is a great way to grow, and quite often can bring expertise and experience around the table that you don't have, that allows you to be able to have confidence in making decisions. And my personal experience of my board was game changing in the role that they played to make us ask questions of ourselves that we probably wouldn't have done otherwise. In my first business I started, was that 2012, I was pretty green on some of the things that would set us up for future success around compliance and tracking board meetings, board minutes, key decisions, etc., that get interrogated around the due diligence stage. So, having that foundational compliance on the early stages is important too. So I think there is good value. Like non-dilutive can be great if you're aggressive, confident, and you feel like that you've got an advantage and you can get some capital, but you retain the equity. And those kind of people quite often are looking potentially for something that's sustainable that they can control. And so I think that part too is like what kind of fundraising you want to do, and then sort of building your own profile. And this is a whole episode in itself, but your own personal brand is something that's major focus at the moment. So as a founder, you almost need to be known, sometimes even greater than the brand or product that you're building. So the ability to have your own network and leverage that to be able to open doors. And if you don't have an active network, being able to build that and grow that allows you to find different types of options, and there may be an opportunity that comes your way for investment in something that you didn't expect as well. So for me, there's four tranches that I would sit around that. So I think that would be my shortcut steps.
Yeah, I mean, it sounds like timing is key, right? And building your network. Yeah, Mark.
Yeah, I'll throw a twist in this, right? Because we're talking about it like it's binary, one or the other.
Right.
It's actually both in a lot of cases, right?
Mm-hmm.
So what I would challenge founders or boards and executives to do is figure out what capital you need, right? And you're going to write that down. What do we need it for? Well, we need X amount for, R&D. We need X amount for acquisitions. We need X amount for fulfilling orders. We need X amount for building this new factory, right? Okay, now you know the total amount you need. Now look at the things that you need it for, your use of proceeds, and see if any of those things are non-dilutive capable, right? So if you're going to build a factory, the factory's got a 20, 30, 40-year life cycle. It's expected to produce a lot of capital in terms of revenue. It's also going to have assets, right? So people will lend against assets. People will also lend against future revenue. So you could get a loan to build a factory. You don't need to raise equity necessary for the factory. You're going to do R&D. You could probably find some non-dilutive, but it's going to be harder. So you're going to probably want to do equity for something like that because you're making big bets on things that aren't proven. Hard to finance something that's not proven, right? And so you look at your use of proceeds, and you might say, well, 40% of our capital is going to build the things we've already sold or we know we're going to sell, like I was talking about earlier, like purchase order financing. Okay, totally non-dilutive. So you look at your requirements, and you might go to the market and say, we're raising $10 million in equity and $50 million in non-dilutive. These are the structures we're looking for. These are the assets we're going to underpin them with. So again, that sounds more mature business, but you could also do that at a very relatively young business, just different numbers, right? So I think if you know what you're looking to use the money for, that tells you what's the right hybrid of financial structure.
Yeah, great insights. I love all of that. And so one last question for both of you is, where do you see non-dilutive funding landscape going in the next 5 to 10 years?
I think that people are actively exploring new ways of getting capital, driving revenue growth, and being more self-sufficient. And that education that comes around that, it's network-based still. And I saw a provocative headline the other day where someone actually said that their forecast was, and I don't quite agree with this, it will go this far, but it's an interesting conversation, is that it'll get to a point where bootstrapping and self-sufficiency will start to become more normal, and VCs will need to pitch founders to be able to become part of their journey. And I think it was a provocation, but I find that interesting. And I think that education, as I said, and understanding ways to grow and being smart about growth, and that real sort of we have the progressive process. It's how do you be frugal and aggressive and find ways that are free platforms, people that can help you along your way, and hustle to be able to get growth in that. And I think that organic kind of hustle is what's going to become the norm as a way to move forwards, and then start to explore other ways to get investment in, probably under more controlled circumstances.
Andy, as you were talking, I literally just had a NewCo idea. We need to build a platform so that founders who are looking for non-dilutive funding from various sources can come right on there and find it. Because I would imagine it's hard to figure out where you can get it, right? And so, Mark, what are your thoughts on the next 5 to 10 years? Where do we see this going? Are we building a NewCo?
Yeah, no, I'd say it's probably the next 1 to 2 years, to be honest. So what you described is already out there, right? I would just say they're going to be more polished. So if you are trying to get a credit card, you want to get a car loan, you want to buy a house, you can go right now, click a link, and in 60 seconds have an answer probably, right? And that's where non-dilutive capital is going to go. And there's plenty of platforms and founders right now that would tell you we're already there. But I would just say there's going to be a little bit more evolution of the polish, but we're probably 12 to 24 months from being there in terms of what we expect as a consumer will be the same in terms of non-dilutive capital. Now, let me take it one step forward. When I was talking about the purchase order financing and stuff, I mean, I ran some very large e-commerce sites, and that was the kind of business we were always juggling. The more success you had in sales, the more money you needed to actually produce the product, right? And so where the trade financing world, again, think commercial, manufacturing, that kind of stuff, got to, this is 10 years ago, they would link into so we would sell a lot of stuff through Amazon, Bed Bath & Beyond, Best Buy, all these big companies, right? But you could give them the credentials to your vendor portal, and it became all automated after that. They could see your purchase orders. They could see which things have been paid. They could see which things were still open. And with that, they could do a calculation of what credit was available to you. You never had to talk to a banker or fill out any paperwork. You just drew down your credit line based on what your portals or your big customers told you. So imagine the same kind of thing. If you have a SaaS business and it's all going through, I don't know, pick your platform. It's all going through one of the main platforms in the SaaS space. You just tie them into the platform and they can see your sales, your historicals, your future, and they will be extending you credit with the click of a button. That's where it'll be in the next 24 months for sure.
Very cool. Very cool. So the bottom line is you need to be proactive, right? And research all the available opportunities that are out there and to get advice from industry experts like Mark and Andy. And so for those of you that have been following us, Mark and Andy are, again, leaders at Nobody Studios. You can reach out to them if you want to pick their brains on this topic. And then as you've noticed, we've switched our time. So we're going to be doing now the Team-Own live stream every Thursday at 10 o'clock. So we're trying a new timeout. So make sure you join us next time. And thank you, Mark and Andy, for joining us today. We'll see you next week.